LiDAR stocks are the topic of today's presentation, and in this LiDAR stocks update, we're going to look at names like Luminar, Innoviz, Aeva, Ouster, Cepton, Velodyne, Aeye, and the like. So we've been following LiDAR for a very long time. The idea is that LiDAR as a technology provides a way to invest in autonomous vehicles, a pick and shovel play. Now, Elon Musk is famous for having said that LiDAR is a fool's errand, but there are also a lot of other use cases for LiDAR, such as last mile delivery, robo-taxis, things like that. So it remains to be seen whether or not LiDAR is a key component of autonomy or something that simply supplements things like advanced driver assistance, ADAS. So what it comes down to is revenue growth. Now, the companies we're going to look at today, you can see here the return of 7 of these firms since they had their SPAC debut. And it started really with 8 LiDAR stocks, and now our number is dwindling. So Velodyne merged with Ouster, and we'll talk about that. Quanergy went bankrupt, so that was the first one to implode. And then we have a new entrant, Hesai. We'll talk briefly about that. But when you look here at the remainder of the names, you can see that they haven't performed very well. Now, when we invest in disruptive tech companies, we don't consider anything with a market cap of less than $1 billion. So that would just leave Luminar. But we would question whether or not this thesis has any merit at the moment to begin with. So let's start talking about these companies. Aeye, this isn't a business, and this is going to be a recurring theme throughout this presentation. Look at the table there on the bottom. You can see revenues over the past 5 quarters and how the cost of revenue is more than total revenue. So you're selling something for less than it costs to produce. That's not a business. We don't invest in companies or take them seriously until they solve that problem. And people will point to Tesla. We'll go take a look at Tesla's past financials, and you'll see that they didn't have this problem when they had their IPO. This is a big problem. These companies are essentially subsidizing their product, and they can only do that for so long before they run out of cash. In Aeye here, you can see the top table there, their cash over time. Look how steadily that's decreasing. So what? They should be out of cash in a year or so, and they'll need to raise. Things aren't looking so good. They'll have to give away a lot of the company or raise debt. So with a market cap of $30 million, this little blip isn't something we would ever take seriously. Cepton, next on the list, has a market cap of close to $80 million. Now you can see the same sort of problem here, but maybe not so bad. The real issue that we have here would be the fact that we don't take companies seriously until they have a full year of revenues exceeding $10 million. So we don't annualize that either. So if you look here, you can see that in the second quarter of 2022, they had $2.5 million. So if you annualize that, you could say, well, they exceeded $10 million. Well, that's exactly why we don't annualize. You could see that for the rest of the year, it's sort of piddled out. And then when you look up there, the table above shows this consolidated on a yearly basis, just to show that they don't seem to be going anywhere fast. And 2022 saw revenues of $7 million, and it remains to be seen what they do in 2023. But that's another key rule, is that we don't consider companies unless they're able to breach that $10 million mark. Now, this brings us to Ouster and Velodyne. Ouster is a company we liked because they were selling LiDAR solutions across different industry segments, not just auto. Now, they merged with Velodyne, and these 2 tables here we took off the Velodyne SPAC deck. This was an article we did, I think, 3 years ago when Velodyne became the first LiDAR stock to debut. And you can see here this top table, revenues declining over time. That's not a good thing, but then they tell you that this is driven by their goal of increasing adoption through decreasing price. Well, that starts to put pressure on the margins, going back to that cost of goods sold being more than revenues problem. But then when you look at the table down here, they were projecting this, last year they projected to have close to $250 million in revenues. They didn't come anywhere close to that. And you can see this table here talks about robo-taxi being a key component of that. Well, we're nowhere close to having robo-taxis deployed in cities across the U.S. We did a recent piece on updating on a look at full autonomy, and we're a long way from that. And you have last mile delivery was the biggest component of their estimate. Now, we have a big problem with management teams that provided these grandiose visions of success to retail investors in SPAC decks and essentially screwed them over. This is pretty bog standard across all SPACs, where they promised the moon and just delivered nothing except pain and suffering and a lot of losses for retail investors who bought these stories. This is why we don't invest in stories. So we did a piece on a recent research piece. I'll put a link to it in the description of this video that details this particular merger, because it's really where our focus lies when it comes to LiDAR stocks. But let's move on to Aeva. This is a free LiDAR business. So their cash and marketable securities of $288 million exceeds their market cap of $260 million. And retail investors will often point to situations like this and say, well, look, essentially what you're getting here is an arbitrage. You're getting an entire LiDAR business plus net around $28 million in cash, the difference between market cap and cash. Well, there's a reason for that. Everybody can read how much cash they have on their balance sheet. This is simply because the market doesn't believe this company is going anywhere. And when you look at the table on the right there, that's the concern, right? So again, we see a firm that can't break the $10 million per year mark. Over the past trailing 12 months, they've burned through $100 million in operating costs. So what? They have about 3 years left. They say here, and this verbiage, you got to be real careful about this. They say we are progressing well on our engagement with a top 10 OEM. So a lot of focus is being placed on a single customer risk, and are in discussions to deepen our relationship. That's nothing. That means nothing. Show us the money. So the market doesn't seem to believe that Aeva's going to be able to do that. And then when we look at Innoviz, here's another example of a company that's saying one thing and demonstrating something completely different. So revenues in Q1 of this year were $1 million, down 43% compared to last quarter Q1 2022, where they had revenues of $1.8 million. And look at this verbiage here. They say the year-over-year decline in revenues was driven primarily by the progress in the BMW program as it approaches volume production. Well, if that's progress, we want to see less of it. And then they say here, the transition includes a shift from selling full LiDAR units to selling components to Magna at lower production average sales prices. Not looking good. All this great news translates into a whole bunch of fluff and then one meaningful statement when it comes to what they expect to accomplish. 2023 revenues in the range of $12 to $15 million. Great. So Innoviz investors need to hold them to that. They need to make sure they hit that goal. And then when they do, what's the cost of goods sold? Now, the problem here is that this firm is running out of cash. They have $156 million left, trailing 12 months operating cash flow losses of $93 million. That brings us to Luminar. And you can see here, they have the most revenues of all the firms that we've talked about today. But look at this. We still have this pesky problem of producing products and selling them for less than they cost to produce. Look at the trailing 12 months. They brought in about $41 million of revenue at a cost of $100 million. Now, they have a fair amount of cash, and if you look at the table on the bottom, you can see how that's nicely being depleted over time in a steady fashion. And we're just going to close this out by saying one thing. Our approach to LiDAR SPACs going forward is going to be one single statement here. If you're selling $10 million of something or more in a single year for more than it costs to produce, we'll take a look at what you're doing. Now, you may say, what about Hesai? They're doing that. Well, before we start looking at Chinese LiDAR companies, and China, investing in China is a risk in itself. We've talked extensively about the risks of investing in China, and I took a poke around. This isn't set up as a VI structure, which is great to see. But before we start digging too far here, we should ask a bigger question. How big is the LiDAR opportunity? And I took a look through a lot of market size estimates by various analysts out there, and this is what I came up with. You can see here, somewhere around, let's say, $8 billion average out, forecasting the growth from today with what seems to be around $2 billion opportunity. And that just isn't of a size that's that appealing. And that's especially true when you consider there are a lot of firms dabbling here, not just the SPACs that get all the attention. So you see here, this research report was actually pretty good. It says the global LiDAR market is fairly fragmented with many large and medium-sized players. Then they go here and list, 9 different firms that we haven't even touched on. So when it comes to trying to figure out if there's a leader, because we invest in leaders, it's very hard to see who the leader might be. And you can see here some other developments. You have Continental partnering with Umbrella. That's a firm that we've covered and whatnot. So this is a very fragmented market, and there's no apparent leader. We like to invest in leaders. There's a mediocre TAM, most estimates under $10 billion into the future. The publicly traded pure plays aren't very compelling. And when you're dabbling in hardware only, margins are going to be compressed. That's why it's important to have a software supplement to help boost those margins over time. To be honest, we're just not quite sure why there's such strong interest from retail investors, because we don't find this theme to be very compelling at all. Now, if you could do me a favor, please click the Nanalyze logo on the right, subscribe to our channel. Then I put up another video here that you might like to watch. Thanks so much for taking the time to watch this video today.